Live. Welcome back to Boss Uncaged podcast. So this show is going to be pretty funny. I'm going to start it off with like a little inside joke behind the scenes because we were talking off air, and he was like, Sarry was like, "Hey, do you remember me? I've been on your show before." And I was just like, "You have?" Like, and usually 9 out of 10 times I try to remember everyone that has been on the show, and it's like it got to the point to where Boston Cage goes, we've interviewed hundreds of people, so we're sitting here talking, and he was like telling me some stories about what we talked about live, and I was like, "That's interesting." And then he brings up a name of someone that I interviewed before him that was his mentor, and then everything came back to light. So essentially, this is a new episode, and that old episode I don't even think has even aired yet. So it's kind of like these nuances that you can kind of see how someone progresses from where they were and where they are right now. So I'm going to give you a new nickname, and the new nickname is going to be the Asset Protection Boss. So we're going to be talking about essentially asset protections. So Sarry, why don't you tell the audience a little bit more about you and what's been going on since the last time we spoke?
Yeah, I say thank you so much for having me back. It's glad to be. I'm happy to be back here. Yeah, so a little bit about what we do. We run a company called Financial Asset Protection. It's a financial services firm in Chicago, Illinois, and we help clients in pretty much all 50 states. Just like the title of it, asset protection. We do a lot of financial servicing, planning, budgeting, counseling. A lot of our clients are real estate investors. That's kind of our specific niche, and as well as other types of business owners. But that's kind of how we've structured, and our main focus is helping clients protect their wealth, because that's a really big part of making money, right? Is also protecting and not just having it exposed to different risks.
Got it. So with that, like this breakdown, like the
Yeah.
definition of what kind of protection? Because I mean, obviously, protection. Someone may think my money's in the bank, it's safe. Someone may say my money's under my mattress, it's safe. What kind of protection are you talking about when you're talking about asset protection?
Yeah, so we're talking about market. No, so I'll answer that with the different risks we address.
Okay.
So market risk is one of them, right? We're protected against market volatility, like the stock market going down and your money being tied up there and then it going down as well. So we want to block or hedge against that type of risk. Another type of risk is like creditor risk, right? People like suing you. This varies, right, on states, and I'm not an attorney, but we do work with different attorneys that are affiliated with us, and we can refer you to them. But there's creditor protection amongst the services we provide. Also, like liquidity, like that's really important, right? Like it doesn't make sense to tie up your money somewhere and not be able to access it. So we want to free, make it more liquid to yourself. So, and then also taxes too. We want to create a hedge against future increase in tax rates. So we protect against taxes, market volatility, liquidity, and creditor risks.
So let's dive into liquidity for a
Yeah.
minute, right? So obviously, in whatever vehicle that you're talking about, and I think the most common vehicle that people are essentially familiar with is probably like an investment plan of some
Mhm.
sort, right? It could be the stock market, it can be a 401k plan, and they want to get access to it, right? So first
Yes.
of all, you got to pick up the phone, you're going to have to call, you're going to have to tell them why, all this other stuff, and then they'll essentially wire the money to you. It may take essentially 3 to 7 days before it hits
Yeah.
your account, right?
Yes.
So when you're talking about liquidity, what are you talking about as far as defining it?
Yeah, I'm talking about no questions asked, just how much do you need? Where do you want it? I'm also talking about no penalties or downside. There's no downside risk to accessing the money. So that's what I mean by liquidity. And to go further into what I'm talking about, when we recorded last year, I think we dove deeper into the bank on yourself concept, which is our primarily root, our primary concept. So that's exactly what we specialize in. We specialize in the bank on yourself concept. I think you also had Mark Willis on the podcast who
Yep.
spoke about the same strategy. So what the strategy is, it involves one to be able to access their funds within 3 to 5 business days with a one-page form or something. Nowadays, they even have it online where you can just go online, put your policy number in, put how much money you need, and they'll transfer it to an account that you want. Again, there's no downside risk to that. The only thing is there are limits to how much you can take out based off of how much cash value you have in the policy, right?
Mhm. So
So, mhm.
when you talking about policies, and this is kind of like that was a good segue to kind of talk about the
Yeah.
vehicle that you're leveraging right now. People that are familiar with life insurance plans, but they may not be familiar with how they can use life insurance to protect their assets, protect their wealth or help them
Mhm.
grow wealth. So let's talk about your strategy. Let's say I come to you and I'm saying, okay, I have $10,000 of liquid. I
Yeah.
may have a 401 plan. I may have some other stash of cash and different assets. I may even have real estate. How can I kind of leverage this platform that you're talking about?
Yeah, so one thing you could do, I would ask you, we would do a full financial analysis, and one thing we would ask is that 10,000 is just a one-time thing, or is this per year? So let's just assume that you were going to do $10,000 per year, which is that's pretty average for our clients to do $10,000 per year. Instantly, as soon as you put 10,000 into one of these policies, you can turn around and leverage it, borrow against it. So
Mhm.
it's leveraging just like real estate, right? You would imagine you bought real estate with cash, you can then turn around and borrow against it. Very similar to the situation, right? You have a life policy, you fund it, you turn around, you borrow against that, and then you can use that for real estate or other investments and things like that. Then I guess it would draw the question, right? Like, why would I do that? Why would I put money into a life policy, borrow against that, and then use for other things?
Mhm.
Well, it kind of goes back to the asset protection, right? Protecting against market risks, taxes, things like that. But more specifically, so to go deeper into the benefits of it, the growth of the policy is tax favored. The cash value is not affected by market conditions. It's protected from creditors in most states. So there's more deeper roots into the policy and how it actually connects with the business owner's case. Because anybody, I guess it doesn't make sense to say, it's good for a business owner or it'll help a business owner. Rather, what is the business owner potentially facing? And then how can we hedge against those risks? I think that's kind of a better way to position things is what are we potentially facing that could interfere with our financial plan, and how do we hedge against some of those risks? And bank on yourself typically could hedge against those risks.
Okay, so with the bank on itself method, obviously you're leveraging the rule of 72
Yeah.
compound interest, right? So I mean,
Yes.
I think that's one of the key things. If you're taking that money and you're putting it into a vehicle, it always comes down to the percentage of return, right? So what is the return on investment? Obviously, a standard savings account is under the rule of 72. You could double your investment probably decades after you're dead, right? So with, with the
Yeah.
insurance policies, I mean, on average, what percentage of return are we talking about?
Yeah, it's a good question. So with policies, we're talking very conservative, right? We're talking boring rates, 3%. That's still, I think, 30 times the average savings account rate, and plus dividends. So with the interest and the dividends you'll get in the policy, we're looking at maybe like 5% compound interest over the long run. Again, these numbers, I know they're not that sexy, right? You could do a lot better in real estate and other places, but the point is not necessarily rate of return. The point is protecting your core, protecting the foundation. So that this is where it goes back to, why fund a whole life policy and then use that policy to fund other things.
Mhm.
That's what I'm doing right now, right? I have three policies. I use these policies to fund other investments where I can potentially, I mean, my goal outside of bank on yourself is definitely above 10% internal rate of return. That's what I aim for. But I
Mhm.
use my bank on yourself money to reach those higher IRR goals. So
Mhm.
that way, if those investments sink, and they could, right? These are higher risk investments that I'm involved in. I still have the bank on yourself policy to fall back on. And then to go further into like the rule of 72, right? Like that's a good observation you mentioned that. So rule of 72, you take the number 72. Let's just say we're talking about an investment with 10% interest that you would earn. You would take 72, divide that by 10, you come up with 7.2. This means every 7.2 years, your money would double. And that's kind of what bank on yourself is about. It's about how often can you double your money. So in this case, if we took 72 divided by 5, just in the policy inside, you're looking at doubling your money every 14.4 years. That's the interest and dividends compounded together, plus the growth you would see in other places outside of the policy, like in real estate and small business bonds. And there's a lot of other clever investments and things like that out there. But we use our bank on yourself policies for these types of investments.
So let's just dive into this a little bit deeper, right? And
Yeah,
I think because we've already been on the show. I mean, we
yeah,
could talk about you and talk about like things have changed, but I think we can really dive into this concept a little bit.
yeah,
So
for sure.
suitability, right?
Yeah,
And anyone that kind of understands suitability when you're talking about stocks and you're doing these trades, potentially an older
yeah.
person, they need to be a little bit more liquefied versus
Yep.
someone that has more time on the calendar to kind of let that money sit and grow over the years. So with this particular policy, let's say someone is like 50 to 60 years old, is
Mhm.
that something that's still going to be suitable for them, considering that you're talking about a 14-year, 7-year return?
Exactly. Yeah, that's a good question. So typically it's better, obviously. The better, the younger you are, the better it is. That doesn't mean that if you are in your 50s and 60s, we can't help you. The oldest, I mean, not the oldest, but like one client I've helped was probably, 77 years old, and he was able to do a whole life policy. So there's still a lot of room for that. I think that just like the upside of doing when you're younger is you have more time for that money to compound. But in this situation, the advantage to people in their 50s and 60s, they also have had some time to build up other assets, right? Like 401ks and IRAs and real estate, other places like that, in which those people could, depending on their financial situation, fund a much bigger whole life policy, right? Where they can do like 500,000 or $600,000 into a single premium whole life policy, where it's just one-time payment. They're moving assets from point A to point B to
Mhm.
seek alpha, right? To seek advantages in taxes and asset protection and to protect against market risks. So yeah, I guess it all depends. And this is where the financial analysis comes in, where we understand the client's needs and where they want to go and kind of what situation they're in. But yeah, you could definitely do, I think the life insurance limit as of today for the actual insured is about 80 years old. I don't think insurance companies will insure somebody over, and I think you're a licensed agent, right?
Yep.
So I probably agree. There's really no company out there that'll insure somebody over 80. Maybe there is, maybe somewhere there is, but for the most part, probably not. However, you don't always have to be the insured
Mhm.
to be the owner. You could own a policy and insure somebody else, like an employee, a business partner, a child, somebody else in your life, somebody in which you have insurable interest over, like you take care of them or they take care of you or something. There's some sort of financial relationship amongst among that person. You could be the owner of the policy and then they could be insured. We do that all the time too with clients that are essentially uninsurable. There's always like some sort of solution we can figure out for them.
Hmm. I mean, it's definitely interesting. I mean, because obviously the
Mhm.
word that's always shunned upon, right,
Yeah,
is essentially the word guarantee, right?
yeah, for
Like
sure.
anytime you hear stocks, you hear guarantee, you're like, holy shit, I'm about to lose my damn money, right? If you
Yeah,
hear the word guarantee and you're talking about like the housing market, you're probably gonna lose your damn money. But when it comes down to these insurance packages,
yeah.
that's a word that's used over and over again. So, like, how is that possible for a word to be used in the similar market sector when all the other vehicles potentially are not guaranteed, but this vehicle is guaranteed? How does that work?
Yeah, somebody asked me this question, an investment advisor. I was talking about this, and she was like, "You can't use the word guaranteed." And I was like, "No, actually, we could because I'm referring to a savings option. I'm not referring to an investment." So typically, cash value whole life insurance falls under the category of savings. So
Mhm.
it is possible to have a savings plan that is guaranteed. So that's one aspect. We're talking about savings guaranteed, not an investment that's guaranteed. And then the other side to that is what makes that savings option guaranteed, like what is it about, one of the mutually owned insurance companies we work with, what is it about them that allows them to guarantee certain returns? And to go deeper into that, they've been in business for well over 100 years. They have a proven track record of paying out claims and dividends and cash value for over 100 years. And then to go even further into that is, how are they able to do that? Well, they're able to do that because of the state and federal regulations. They can only invest in certain things. In insurance companies, mostly like 60 to 80% of their portfolio is in bonds, very conservative. The other 20 to 40% is in private loans to other financial institutions, to real estate developers, real estate investors. So they're primarily involved in safer investments. Plus, they have the reserves to back up the downside to those investments. Plus, they're also they invest in certain areas that go up when the stock market or markets go up, and they also invest in other areas that go up when the stock market or other markets go down. So they're kind of in a position where, because of their reserves, because of the financial backing they have, they're not on the same level as, for example, if I took, $500,000 right now and I put it in the stock market, I'm not going to have the same power as the insurance company is in bonds and in real estate and other areas. In other words, they're able to compound their reserves it well into the future, regardless of market conditions. That's how they're able to guarantee the policy owners the cash value growth, the dividends. The dividends aren't guaranteed, but still very high degree of certainty of paying out those dividends.
Definitely, it's interesting. I mean, for
Yeah,
the listeners listening, I know like we're spitting out jargon left and right, but I
yeah,
mean, this episode is a little bit different than our standard episode. But I want to kind of give you as much value about this
yeah,
concept as humanly possible because you can leverage this, right?
yeah,
And he's saying you have a range up to 80 years to essentially leverage this, right? I mean, policies could be still be given out at age 50 and age 60. Potentially, you have 20 years to leverage this. So let's just talk about this in relations to like a CD, right?
yeah,
You're
yeah, for
talking
sure.
about 3 to 4% standard CDs or fall into that realm. So someone can go to the bank and say, "Hey, I have 10,000. I want to put that into a CD.
Hmm.
You'll get back 3% return on that."
Yeah,
So why would someone want to choose what we're talking about as far as using the banking method versus using a CD, which is coming from a bank?
Yeah, so I think there's three things. So number one, I don't think I think CDs, depending on the bank and depending on the terms, they might be like locked, right? Like you might say, all right, I'm going to put $50,000, lock it for like 5 years, and if you take it out before, there could be a penalty. So the bank could use that money to work with that money. So I guess that's one downside is the control or the terms of it. The other is you have to pay taxes on that growth, the interest. You would get, I think, a 1099 int at the end of the year to pay taxes on that. And then the third aspect is leverage, right? So I don't know, maybe you could get a loan against the CD, but I don't think the bank is going to give you a loan at an interest rate less than what you are earning. So if you're earning 3% in the CD,
And
especially right now, I don't know of any banks that would give out interest rate loans less than 3%
mhm.
of the interest. It's probably greater than that. So that'll give you a loss. Whereas whole life insurance is properly designed cash value whole life insurance could do the opposite of those. It is liquid. You can access it before. The growth of it is tax free. The loans are tax free. The withdrawals are tax free if it's properly structured, of course.
Mhm.
And if it's not a modified endowment contract, right? If it's, in other words, if it's a tax free policy, everything else out of it is tax free. So that's kind of the advantages of over the CD. But that's a good observation because a lot of people do compare that. And
Yeah.
I'm doing the CFP program right now. I'm in the fourth course of the
Yes.
CFP program. It's
Very
7 courses, and I'm in the fourth one now, and we went through this. So the good thing about cash value whole life insurance is that it falls in the same category as CDs in the eyes of risk. It falls in that category. So the safest in places to put your money are checking account, savings account, CD, usually money market, and cash value whole life insurance. So it falls into those categories.
cool. Cool. So I think we set up the dominoes. I think
Yeah.
they may still have some questions, the listeners. So let's put
Yeah.
it in a hypothetical situation.
Yeah.
Let's say I'm an investor and I want to purchase a real estate property, and I have, let's say, 150,000 that's
Yeah.
liquid in a policy. I take out the 150, I put it as a down payment, or I make the full purchase on the property.
Yeah.
Then I have to do the payments, right? I have to
Yeah.
pay back that. So you're saying that there's no essentially interest or penalties, but what's like the payment schedule for me to pay something like that back if I took out 150 over the course of, let's say, a year or two?
Yeah, good question. So let's just say, so you have $150,000 in cash value. That's your account value. Typically, you can borrow 90% of the cash value. So let's just bring it down to like 130. You take out 130 out of you borrow $130,000 from the insurance company. So the insurance company is going to give you a loan of $130,000, leveraging your 150 as collateral, or actually the whole policy is collateral. You take that $130,000, you buy a property, let's just say all cash. Now you are the banker, like you are in control of these terms. You now owe the insurance company the $130,000 plus interest. As of today, it's 5% simple interest
Mhm.
broken down annually. So I would recommend you come up with some sort of payment plan. A lot of real estate investors would rent the property out or flip it. Either way, they would pay the loan back either through rental income or through the profit they're going to anticipate on getting. But what's like, I guess, like, what is like the magic or what's like, what's the point of this? And the point of it is that your initial cash value keeps growing, regardless of you having that outstanding loan out. So while that loan is out, while you bought that property, while you have it rented out or anticipating on flipping it, your cash value didn't skip a beat. It kept growing that entire time. And I think that's what's really strong, right? Because if I take $100,000 from the bank, or let's just say in this situation, $130,000 from the bank, and I go buy this property cash, my bank account just went down minus 130, and then I bought a property with that, which is what 99% of people do, right?
Mhm.
Cash moves from point A to point B, a negative on one side to a positive on the other side. But with the use of cash value whole life insurance and bank on yourself, it was never a subtraction. I took out a loan against that. So I get I get the cash growing and I get to take advantage of real estate. And this is something a lot of people are like, what's better, right? Is it better to sit on cash or is it better to take advantage of investment opportunities that are, especially in a very high inflationary period like we are right now, above 9%? What do we do? Do we save cash for the future or do we invest it? Now we can do both. We can save that cash for the future and leverage it for higher risk investments like passive investing in real estate or actively owning a real estate property, real estate portfolio, or other types of investments you could do that'll potentially yield you higher than 10% per year.
Very cool. Very cool. So I just want to talk about you for a little bit. I
Yeah,
mean, and that's what this show is usually about. But I mean,
yeah,
being that we have some history, I just think that
yeah,
establishing while we're talking about what you do and how effective it can be for someone that wants to dive into this space or to become an investor. So in the early days, right? I mean, obviously you went to multiple different colleges, and but your first degree was digital forensics. I want to talk about like how does someone like go from digital forensics into essentially into understanding the market and leveraging policies. Like how does that happen? How does that transpire?
Yeah, it's crazy. My guidance counselor didn't do a good job. No, I'm just kidding. So I just, I was younger. I didn't really know much. It sounded cool to do that. I wanted to get a I got a bachelor's degree in digital forensics. It actually was criminal justice with a concentration in digital forensics. And I wanted to I wanted to work for like a law enforcement agency where we analyze like if somebody deletes like files on their computer and like we're trying to recover that. But as I was going through like the courses and everything, I was like, you know what, I don't really click well with like technology and like programming, and I didn't have that strong of a programming background, right? The next step after that was to dive deeper into IT, learn some computer programming languages. And I didn't see myself doing that. Plus, I like to talk to people. Like I spend like 8 hours a day on the phone or podcasting or meeting with people. So I couldn't just spend 8 hours a day on a computer, like looking at codes and like figuring out trends and things like that. It just didn't blend with me. Luckily, it was just a bachelor's degree. It wasn't that far. Like I know people who finish graduate school and don't and they end up not liking, like I think you mentioned an example, like somebody's a doctor, then they transition into an investment banker. That's a big jump, right? But it's
Yeah.
possible. Anything's possible. So I'm glad that, I guess like the lesson learned is you never really know until you do something, right? It's really difficult to choose something before you actually implement it. So it's okay to major in things, minor in things, do internships, take jobs. You're not going to know until you actually walk through that door. So that's what happened. So I guess like that was a lesson learned. And then, I really wanted to do something in business, something in financial planning. I wanted to help people kind of understand. I had a pretty strong financial background, just naturally, just basic stuff, but I wanted to kind of develop it further. And that's what got me into an MBA and in project management. I like planning. I like talking to people. I like numbers. And then it was like what I'm doing today is exactly what I think I've always wanted to do. I just didn't know what it was called. So, fast forward to today, aside from, whole life insurance, I don't want the audience to think that I just do whole life insurance. That's all I know. It's just a tool in the background. I think what's important is what we're getting out of it. Like the results of the real estate investors not losing money, the results of the business owners able to open that second business. I think that's, what I want to resonate is, the results of it. It's just called whole life insurance. It doesn't mean that that's all it's about.
I think it's definitely interesting, and I don't remember from the last episode or not if you were married at the time, but I know
Yeah.
that you're married now, and it
Yes.
seems
Yes.
like your wife is a complete opposite. I mean, she is essentially a nurse that specializes in the cancer department, right?
Yeah.
So how does that chemical makeup? Because again, that's two separate sides of the brain working. How does that work for you guys?
Yeah, so it's very good and it's very bad. It's very good because our careers never conflict. We don't, there's no like we have different work stress stuff, but it's also kind of bad, right? Because like I have some friends who, it would be husband, wife, and they both own the same practice, right? And then that's kind of cool, in my opinion. They can talk about, life insurance and interest rates and the stock market, and they'll understand each other. My wife is starting to understand more now, but still, I guess there's pros and cons to it. um I kind of, we've talked about her transitioning into financial services, but I don't really see it. She doesn't like it. She doesn't, that's not her passion. I think it's really important just to kind of stick with what she knows. She's also doing her doctorate degree. She's about to finish, has a year left until she becomes a DNP, a doctor and nurse practitioner. So she's going to transition from being a nurse into a nurse practitioner.
Mhm.
So I think that's kind of like, probably better for her, even though I would like for her to be in the same industry as me. It's okay though.
Well,
She's,
I think that there's definitely overlap. I mean, when you're
yeah,
talking about like life insurance, and the definition of life insurance is not a protection for life; it's essentially a protection for income.
yeah,
So understanding that, and she's trying to help people stay alive,
yeah,
there's definitely some overlap right there. Because I mean, obviously, she knows the suitability probably more better than you and I combined, because she's living it every single
yeah,
day in the environment, and she sees what happens, and she knows what happens when somebody passes away and they don't have insurance or they
yeah.
don't have any money to leave behind for their kids. So I would think you guys could definitely partner up, even though you're on opposite sides of the spectrum. I think she could bring some quality and some value into what you do for sure.
Yeah, that's a good point, actually. Yeah, I never thought about it that way.
Well, I mean, I always say I hear voices, man. So I look at things a little bit differently than most people. So I mean, that's definitely cool. So like, let's talk about like, so from last year to this year, obviously you've dove in way deeper into what you're doing.
Mhm.
You're getting more mentoring, more training. You're
Mhm.
getting more evolved. How has that rodeo been for like the past 12 months? Like again, I always recommend for someone to find a mentor because a mentor
Yeah.
can definitely help you. So how has your mentor helped you from where you were to where you are right now?
Yeah, I mean, there's so many different ways the mentors help me. I guess the biggest way is just finding that inner light, your inner like your inner hero, right? Like within you, not just somebody telling you what to do, but also like you finding your inner CEO. That was the biggest advantage of my mentor relationship. And it's ongoing, right? It's not like, I used to do that back then. No, it's still going, right? And I always wanted to keep being mentored. I have a weekly call with my mentor, and like you said, it's very important, especially for entrepreneurs, especially for newer entrepreneurs, right? Because unfortunately, like the failure is so high amongst new entrepreneurs, the chances of success are really low. And again, it's not the person, right? It's just the industry. It's the way that I think we're programmed, right? We're constantly taught, get a job, work in an environment, work with other people. And then all of a sudden you're alone now, self-employed. You need somebody to work with. You need somebody to help you find your inner CEO,
Mhm.
take over, and then it builds on, right? It's like you build on those skills into other areas, and it develops, and it keeps adding up. And there's exponential growth. So you asked me, like, how has it been over the last 12 months? It's definitely been in terms of clients, in terms of guest podcasting, in terms of the podcast we have, content writing, all those areas, luckily, thankfully, have all exponentially grown
Mhm.
because of the training and the mentoring, and things add up and they compound on top of each other. So if it takes you 1 year to do something, the next time you do it, it might take you a week to do it. So like the momentum from the past carries forward, making other things easier and faster to get done.
Mhm. Yeah, the last time we spoke, I think you were just brand new into podcasting, and now
Mhm.
I think you're. I think I just listened to episode 53 of your podcast. So obviously you're more seasoned in that space. So
Mhm.
let's talk about like your podcasting journey for a little bit. Like obviously anyone that understands podcasting, I think everyone should have a
Yeah.
podcast. Why did you particularly start your podcast to talk about what you're talking about?
Yeah. A couple reasons. One, I wanted to build relationships like with you. Like I already feel like it's my second time speaking to you. I already feel like we've hung out before. So I think like from a relationship standpoint, I think it's really good. It's a good way to meet with people, connect with people. And then also like from a marketing standpoint, we upload, this year in marketing, we take the podcast, we upload them in our email list on LinkedIn. A lot of people reach out to us as a result of that. So I'm very thankful for being able to connect with people outside the audience, listening to the podcast. And then plus what we do is very content driven, right? It's not just, get whole life insurance. It's more of how does it help with taxes? How does it help with real estate? How does it help with market conditions? How does it help with inflation? There's a lot of context involved, a lot of concepts within it. So it helps when you have a podcast when you can speak. I just did a solo episode. I launched it. It's gonna go live tomorrow. And the solo episode is just strictly about using my life policy to fund small business bonds and why that, in my opinion, is advantageous. So the podcast gives me a channel, it gives me a platform to dive specifically into certain areas as almost like a reference point for clients. So if a client now asks me, hey, how does this work? This thing with small business bonds you were talking about, I can send them this link now so they can listen to it.
I think it's definitely a hell of a tool, and
Yeah.
what you do, it's always FAQs. Like I could probably ask you a million different questions just coming from a viewer standpoint. Okay,
Yeah.
what is my listener probably thinking about? What does my listener probably want to ask him right now?
Yeah.
So I mean, having an on running FAQ, and that's what I look at your podcast as. It's answering questions
Mhm.
continuously, day after day, week after week, interview after interview. Going back to episode 53, you were interviewing Chris,
Yeah.
and he was talking about like real estate, and he was talking about more so like the West Coast and the
Yeah.
Midwest. So that's a question that I want to ask you, kind of like, are these policies national? Because again,
Yeah.
obviously, California's regulations are completely different than New York and completely different than Florida, right?
Yeah.
And if anybody knows anything about life insurance, there's licenses for New York, there's licenses for
Yeah.
Cali, there's licenses for Georgia, and to get each one of those licenses are completely different. So, like, how does that work when you're crossing over these state lines?
Yeah, good question. So yeah, we could do business in all 50 states. So typically with insurance, you have to have your resident state, right? So like I'm in Illinois, my resident state is in the state of Illinois. And then every time I come across a new client in a different state, I would just go to, there's like a website you go to and you would just essentially buy that new license in that new state. And then now I can work with that client and help them. And typically it's very easy. Some states require like fingerprints, some states require like getting a document notarized. Some states require nothing. You literally just pay, and then like an hour later, they email you the license, and now you're licensed in that state. So it depends on the state. You're right; they all have different regulations. Like I think the big ones, like California, Texas, and New York, it's like a different country. Like almost like they have like different rules and different things. And but for the most part, it's pretty simple. And I'm that's one of the reasons why I got into this niche too, along with the fact that I love the bank on yourself concept, and it is dependent on whole life insurance, which you have to be licensed for. I also like the idea that I could do this work entirely virtual and there are no state limits. Whereas like attorneys, I think it's very difficult for attorneys to do even in just another state. Like if you're in Illinois and you want to do business in Indiana, it's very difficult. Like you would have to go to Indiana, I think, take the bar. I'm not don't quote me on this, but it's much harder to do business from the state to state. Also, same thing with CPAs because of the tax laws. They could do taxes, I think, in other states and things like that, but because of the laws in different states, it's going to be more work for them. So I like this. And also mortgage advisors. I work with a lot of mortgage advisors, and they also have difficult time doing business in different states. They still do, of course, but insurance I think is perfect for like a national business. It's perfect for that.
Yeah, so it's definitely interesting. I mean, so I think you're giving it a twist because some people they hear insurance and they,
Yeah.
they think about the dude with the black suit with a briefcase knocking on their door,
Yeah.
but you're talking about insurance in a completely different way, right? And I
Mhm.
think some people they don't really understand like insurance is not. It's kind of like if you look at car insurance. Car
Yeah.
insurance protects the liability of a car accident or
Yeah.
replacement of the car, right? Health insurance kind of protects your health, but it's more so it gives you back, it saves you some money. It's more of a savings plan, right? If you have
Yeah.
the good health insurance, it works that way. But life insurance is a completely different monster because again, you're not going to get life back.
Yeah.
It's
Yeah.
not going to protect life. So the name of it is kind of like kind of an oxymoron, but in reality, it's kind of protecting the life that you leave behind you. So
Yeah.
you're establishing a situation to where people don't think they can be banks, but understanding what you're doing, then you can leverage your own asset and become your own bank. And that way you have complete financial freedom. Is that not, when you say the correct statement?
Yeah, exactly. It's a very unique type of insurance, right? It's completely different from the other ones. Like we get car insurance hoping to never use it, you know. Health insurance, we're probably more likely to use it. And like you said, it's to save against those outrageous medical expenses. But life insurance is very unique because number one, the claim doesn't go to you, right? When you pass away, you don't get that claim. It goes to a beneficiary or your estate. And then I guess the other part to it too is it's guaranteed. Like if you have a life policy, like everybody is going to pass away eventually. So it's the insurance, as long as that insurance policy is active, the insurance company has to pay that out. But then it brings in the whole savings function, right? Where the ability to put money in. Again, if this was something else, if it was called something else, we wouldn't be using, whole life insurance. We're just using it for the function over the title of it. It's what it could do for us rather than just what it's called or what it does. So we're using it's the savings portion in it, the growth of it, kind of the leverage, I guess, the leverage behind it of using that money over and over again, recycling that money in different places, having it grow, and always, I guess, I mean, it's very advantageous in for business owners, especially, right? Especially in an area where we don't know what's going to happen, in a time where we don't know what's going to happen with the economy. Worst case scenario. You lose money in the stock market, you lose money in a real estate deal, you still have the whole life policy, you still have the cash value in it. I think that's very strong. It's a valid, right? It's a valid reason to look into this. It's a definitely a long-term solution. It's a long-term plan. So it's very difficult. Like if you wanted to churn, $10,000 today into $20,000 in 6 months, it's impossible. You can't do that with whole life insurance. But if you want to, double your money every 14 years and still be able to take advantage of real estate that could double every 5 years and still, get the tax advantages and the growth and the liquidity part, then yeah, I would strongly recommend you look into this topic.
So I'm gonna put the sci-fi on the table, right?
Yeah.
So we're gonna talk about in sci-fi reference because obviously what I'm gonna say is it doesn't exist right now, but what we're talking about it could potentially affect it. So with the dawn of meta and with the dawn of technology and all the things that we have going on right now, death is becoming probably more and more less of a paranoia for people to think about it, because again, we're getting into a space in particular time that someone could essentially live way longer,
Yeah.
or essentially they could be uploaded into the cloud, right? Their memories and who they are as a person could be uploaded. From your professional standpoint,
Mhm.
how do you think that's going to work with banking or with this type of policy? Because again, these policies have expiration dates.
Mhm.
They're usually like somewhere between like 100 to like 110. I think that's like the extended range for like life insurance policies. So when somebody is potentially living for 300 years, how is that going to be affected?
Yeah, it's a good question. So it's the endowment age. And I think they increase it. So when I was doing my licensing like 8 years ago, I think the endowment age, this is the age where the insurance policy just kind of just stops, and they give you the death benefit. And it was, I think, like 95 8 years ago, if I'm not mistaken. Then now they increase it to 121. So the endowment age now is 121 years old. If you have a whole life policy and you live until 121, they give you the death benefit as like the cash value and the death benefit are actually equal at age 121.
Okay.
So I guess to answer that, like what if people live longer? I think they'll just keep extending that endowment age. I think it's a good observation. I never, a lot of I'm actually, a lot of the questions you asked, I never even thought about. And so that's what I think would happen is that they would just keep increasing that endowment age based off of life expectancy. I think it's a little bit past what people are expected to live, right? So even though it's 121, I'm guessing it's a little bit past that. I don't think they're expecting people to live to 121. They're probably, I think they're just going above it just to add in those extra years.
Hmm. Well, what I would think too, technically speaking, you would have to live to 121 to cash it out, right? So that's the other downside to having like standard insurance policies, right? It's kind of
Mhm.
one of those things as well. Until you make it to 95 or until you make it to 101, you're not going to get that liquid. So understanding that, let's say life becomes infinite, right?
Yeah.
We're in the cloud, and as long as there's electricity, technically speaking, we could live forever. Do you think they're just going to just cap the endowment at some time or the other? And again, I know this is all hypothetical, but I'm talking to the listener. I want them to kind of not just think about now. I want them to think about, okay, well, what's going to happen with my grandkids? What's going to happen with my great grandkids? Because potentially they may be in that time frame to what we're talking about may become a reality.
Mhm. Yeah, I mean, definitely. It's the generational part about it is also a very strong component, right? Passing this on to, the next generation. I think it's very difficult for us, right, to think about that, right? Especially when we're like, in our 30s and 40s, we're going to think about the next 2 or 3 generations. I think most people don't think about that, right? Until they're much older, they think about the following generations. And I also think it's actually crazy because there's this whole philosophical part, right, where it's, you're thinking of your older self. Like imagine you're, 30 years old right now, and then you're going to think of your, 80-year-old self. That 80-year-old self is a completely different person. You can't even think about that person. You probably don't even, frankly, you probably don't even care, where you'll be at 80 years old, just because it's too far ahead and there's no connection to you right now. So I guess it's really interesting thinking ahead and thinking into the next generations, and who knows, thinking ahead with life insurance and um in you know the increasing age expectancy. So I think, these are all really philosophical sci-fi
Yeah,
observations.
yeah, definitely very cool. So, I mean, I think the last time we spoke, and I think my memory is starting to get refreshed. I think the book that you had recommended was it Becoming Your Own Banker? Is
Yeah,
that
that's another difference since we last spoke. So there's the book Becoming Your Own Banker by Nelson Nash. It's the foundation of the infinite banking concept and the use of cash value whole life insurance. And there's also, I wrote an ebook called Thinking Like a Bank. It's not really a book yet. It's a future plan for a published book, but for now it's just like a 30-page PDF, an ebook called Thinking Like a Bank.
right?
And it kind of just takes everything we're talking about on this podcast, and it just puts it into more examples, and you can read it. So there's nobody like telling you, how it works. You can just kind of take your time and really process the information. It's called Thinking Like a Bank. And then you could actually download it for free from thinkinglikeabank.com.
So, I mean, obviously, since the last time we spoke, you was an author. So, like, how did that come to fruition? Like, was that something that your mentor said that you should become an author? Was it something that you internally had passions of becoming? Like, let's talk about that journey.
Yeah, so full disclosure, I am not a good author at all. I just had to write. My mentor influenced me to provide content, right? To produce content, podcasts, audio stuff, video stuff, written stuff, to get people, because we're in a space that is not, it's not tangible. So you have to be able to provide people with a lot of information to understand the concept you're referring to. So
Mhm.
there's a lot of, things. So I figured an ebook would be a good idea. It would also be scalable in the sense where I could write the ebook once and then pass it out a million times. And there's also like call to actions within the ebook, right? Like if you want a free consultation, you can click within it and then schedule a time. So it was a marketing full, just to be transparent, it was a marketing strategy, right? To attract new people and to also tell them what we do and how we do certain things. But yeah, so it's, I mean, for me, it was very difficult to write, right? Because I'm not a writer. I didn't really have experience writing. Since then, I figured out faster ways to write and produce content. Like, for example, like back then, I just had like one Word document and I would just keep adding to it and then keep, as if I was writing a paper for school, the same way how one would do it in grad school or undergrad or in other academic areas. You would just, write a paper. But now I've kind of like, learn a bit of tricks and hacks. Like I would, open Google document, click on the microphone tab, and then speak, and then just, this is how this policy would work. This is how this policy would work. This is how taxes, this is inflation, and then just let it all come out, and then go back and edit it all. And then it makes things like you're just taking things from your brain and then just having it flow on paper.
Mhm.
So I guess if I did another ebook now or another book, I'd probably be a little bit more efficient with it. But it took me a long time. It took me over a year just to do a 30-page PDF because of my lack of writing skills, right? I'm not a writer. I'm not good at writing, but I think you develop those skills and it gets better. Check out the ebook. Let me know what you think.
Yeah.
It's, but for me, it was difficult writing, right? Coming up with, the references, remembering what to write about, the
Mhm.
notes for it, editing, compliance. There was a lot of compliance involved with it. But yeah, so that's kind of like the background to writing.
Yeah, I mean, so if you don't mind, if I could kind of give you some insights
Yeah.
to like writing, right? I mean, I'm getting ready I'm working on my ninth book right now.
Oh wow.
So with that book, essentially what I've done is like what you're talking about, like obviously transcribing it,
Yeah.
recording audio, but more so this book is targeted to a particular market demographic, like your book is targeted to a particular demographic. The easiest way to get a fruitful book for that demographic is to look at FAQs. So
Yeah.
look at the frequently asked questions.
Uh-huh.
Go online, go to Google, and see what questions people are asking, right? And then once you get the database of these questions, that essentially you organize those questions. It could be like all the how questions, all the what questions,
Hmm.
all the who, what, where, why questions, and you organize it in that way. And then the only thing you have to do is now fill in the blanks, answer those questions. So the book I'm writing is a podcast book. So a lot of times people have all these random questions. So I organized this book in a fashion that essentially every chapter, every
Hmm.
page answers a question. So by the time you're done reading the book, if you don't have all your answers, then obviously I need to write a secondary book that's a little bit more advanced because the first book
Hmm.
is like the 101, then the 202, then the 303. So look at your books the same way. You have your 101 book. Your
Hmm.
next book should be a little bit more advanced that you're answering more questions from people that are actually leveraging what you taught them in book one. And then book three, book four, book five will just keep advancing them down that road. Does that make sense?
Yeah, that's actually a good question. And I think like Google will tell you, right? Like you can look up the keywords of what people are searching, what people are asking.
Yeah,
Um,
the website is called Answer the Public, answerthepublic.com. So if you go there and you just type in any keyword, it's going to generate an entire screen of the who, what, where, why live from what's happening on Google right now. And
oh
then you
wow,
can
okay.
take that and then you can go to Google Trends and kind of see if those questions or that keyword is trending right now as well. So if you just do those two things, by default, you're going to have a complete database of questions that you know the answers to that the average person is searching for on Google that they don't know the answers. And then now you have a marketing tool that can fill in that void for those answers.
Oh wow, okay. That's very helpful. Thanks for letting me know that. I didn't know. I I knew that there was some ways, but I just assumed that one would have to be a little bit more like tech savvy. Like you would have to know a little bit more about SEO and how to find these keywords where people are searching. But this is a much faster way. Answerthepublic.com.
Yep. 10 times faster. And again, you don't necessarily need to be a writer. You can
Mhm.
just answer the questions. Like the same
Yeah.
where I'm asking you questions and you're
Yeah.
responding, transcribe these questions into a chapter. And again, I would say like with my new book structure, all my chapters are essentially questions.
Mhm.
So that way, when somebody's flipping through the book, they will automatically see the questions, and that question, 9 out of 10 of them, well, some of them should spark that interest. I've always wanted to know the answer to that,
Yeah.
and then it becomes a marketing tool because they're going to purchase the book just to get the answer to that one from that one chapter.
It's smart. Okay.
Make sense?
Yeah, it's really smart. Yeah, thanks for letting me know that.
Cool, cool. So like, so where can people get your book? And let's talk about like, and obviously, I think then until now you have some new websites and some new online portals. So let's
Mhm.
talk about that.
Yeah, so we have thinkinglikeabank.com. It's where you can download the ebook, and then it's free. It's a free ebook you could download. Plus, the podcast is called Thinking Like a Bank, where we interview people, primarily like showing people how to save on taxes, how to grow more wealth, how to invest in real estate as a limited or passive investor, how to, pretty much how to kind of look at money differently from a different financial perspective. And we're launching episode 68. Tomorrow is going to be my first solo episode. So all the other 67 podcasts were all guest appearance where I was interviewing a guest, and tomorrow is going to be the first solo. So that was a whole separate project in and of itself. I don't know if you've ever done a solo episode,
Mhm.
but it's completely different than having a guest speaking.
Yeah, yeah, it's definitely there's so many different flavors of podcasting, and it kind of I like the interview style because you can leverage the asset of interviewing, like my audience and your audience compounding, like we talked
Yeah.
about the rule of 72. Every single
Yeah.
time we interview someone, that account compounding effect happens.
Hmm.
The individual episodes for me when I do mine is more so education,
Hmm.
or like what I just did with you talking about like leveraging the book or
Hmm.
10 tips to do something. Those become more so like lead magnets
Hmm.
for something that I can help someone with behind the scenes, or a product or a service that I can sell and help someone. So if you mix and match them, I definitely see value in both of them. Just
Hmm.
do it on a schedule.
Yeah. Yeah, for sure. It's a good observation.
Cool. So I got a bonus question for you.
Yeah.
Now, obviously, last year to this year, significant things have happened and changed. And you're married, have a book, you're
Mhm.
more influential in your space. You have a podcast. As of right now, what is your most significant achievement to date?
Um, Significant achievement. Just sticking through entrepreneurship. I think that's like the biggest thing that I'm just proud of is just sticking through with it, staying in business, and believing in myself. I think that's the most important thing, I think. I know it's vague, but but I really like, I can care less about the materialistic things and the other things. I like the fact that I told myself I was going to do something, and I trusted myself, and I didn't, I followed through with something.
Very cool. Very cool. So I could definitely tell you, I mean, because like I said, it took me a while for my memory to start kicking in, and so like that, all my photographs are popping in from the first time we interviewed. So and I think it's definitely cool because again, this is kind of like the real first time I'm interviewing someone a year from the year before.
Yeah.
I can kind of see your evolution. I could see you've matured, you've grown, and if you expand your knowledge base, and then I think that's what this is really about, right? If we were talking about the same exact things that we talked about the first time, then what kind of growth did we have in the past year? So for you, I
Hmm.
definitely want to commend you first of all
Oh,
for
thank you.
growing and learning and communicating and building, writing books and podcasting and everything else that you're doing right now. You're heading definitely in the right direction.
Thank you.
Yeah. So in closing, I mean, you're a podcaster now, so you have the opportunity to become the host of the Boston Cage podcast. What questions do you have for me?
Yeah. What are some of your next, other than your book, what are some of your new projects coming up?
So I have dozens of projects, so I have to kind of put them and organize them.
Yeah.
So like my biggest project, secondary or parallel to the book,
Hmm.
is my Accelerator program
Uh-huh.
for podcasting. So that's the
Okay.
big thing that I'm working on essentially behind the scenes right now.
And is that where like you help people expand in podcasting?
So there's two target audience. One
Hmm.
target audience is essentially small business owners, founders, startup founders, particularly that have companies that essentially have at least 25 employees that
Hmm.
are particularly to say $10 million in revenue. And
Hmm.
the goal would be to kind of archive their general information, their general conversations, their thoughts and their processes, and where the company is and where they see the company going in
Hmm.
an internal podcast. I always say, imagine if Steve Jobs had did something like this.
Hmm.
Where would people be listening to Steve Jobs right now?
Hmm.
How things may have been a little bit different for the company 10 years down the road, right? Or
Hmm.
20 or 30 years down the road. And on the other side is for newer podcasters that are
Hmm.
in the space, but they're having difficulties systematizing. They're having difficulties optimizing and automations. And because I mean, at Boston Cage, I would say probably 75% of what we do in this podcast is automated or systematized. So that's why we can do it at scale, and that's why we're at like 300 episodes, but we only
Yeah.
release 150 because everything is systematized for
Hmm.
the most part. So when I'm actually interviewing someone, I'm 100% engulfed in that interview, and I'm
Yeah.
not worried about everything else because I know everything else is going to be taken care of.
Yeah, that's, yeah, that's really important. Yeah. being in the moment, and even I loved it, like being how no matter how busy you are, like you're just doing one thing at a time. I think it's really important, that's actually a tip for getting a lot of things done, is do one thing at a time.
Yep, yep. And I think if you're a podcaster, you got to find passion in it. It's
Yeah.
not. I'm gonna say it's not for the faint, right? It's not for the
No.
weak-hearted because again, it's media. So you have to be choice with your words. You have to do your due diligence. You have to do your research. And like when I found your information when it came in, I didn't even think. I think it happened two other times where I had somebody that came from a podcast recruiter
Yeah.
that was on my show, and I kind of flagged it, and I was like, "Hey, I think I just interviewed this person like a week ago or last month or
Yeah. Yeah.
whatever."
Yeah.
So for yours, it was like a whole year, so it didn't, and I just went through the same routine that I always do, did all my background research, and be honest with you, a lot of the stuff that I remember from before now has changed. You've evolved into a whole new person essentially. So it was definitely a good experience to have this interview a year later.
Oh, thank you. Yeah, that was thank my assistant for that, for reaching out to you.
Will. You have any other last questions?
No, man, it was a pleasure being back on. It's for the second time. I'm looking forward to coming back on the show, and you're more than welcome to come on my show to be a guest.
Yeah, just let me know, and just if you want your system to make the connection, or if you
Yeah.
have systems behind the scenes, just let me know, and I'll definitely will be honored to be on your show.
Oh, thank you.
Great. S.A. Grant, over and out.